Continuing towards the second question of the March and June 2023 exam of AAA, we have a question named Gloop Incorporation. This is the question number 2 within March and June 2023 exam. If we read the introduction of the question, it clearly says that, let me do this. And coming towards the question, it says that it is 1st of July 2015. You are a manager in Gloop Incorporation, a firm of chartered certified accountants which offers a range of assurance services. So basically, whenever there is an introduction like this, that we offer a range of assurance services, this means that the examiner is going to ask a question about other audit services that we used to provide. Now, if I move towards the last area of the syllabus of AAA, that was other audit services or other assurance services. Within other assurance services, there are different types of services. These types of services are divided into two parts. The one are assurance services, in which we actually provide an opinion to the client, just like we provide an opinion within the audit report, within the audit of 12 months financial statements. These services include four types of services: assurance services, review of interim financial statements, PFI. This means that prospective financial information. The client would have prepared some sort of future financial information to get a loan from a bank or to get new investors in a new product, and we will have to provide an opinion upon those prospective financial information, whether it is correct or not. The third one is due diligence reviews. Due diligence reviews are two types of reviews: the one in which we provide an opinion, that is the assurance services, and if we are not providing any opinion, we are just going to give some facts to the clients, that whether you should acquire this company or not. The facts of the clients, the client has requested us to provide them with this information and no opinion, then it is an agreed upon procedure. Otherwise, majoritarily, a due diligence would be an assurance service providing an opinion whether we should acquire or not. And the third one is social, economic, and environmental financial statements or financial reports, in which clients prepare their integrated report, sustainability report, and we have to perform a review of that as well. Now, the difference between a normal 12 months audit and the rest of the assurance services in which we actually provide an opinion. Remember, non-audit services are divided into two categories: one in which we are providing an opinion, and the other one is in which we are not providing any type of opinion. If I come towards the notes that I gave to all of my students when we were actually studying the AAA syllabus, if I come towards the notes for this, then this one. Yes. So if I come towards the notes and give you a brief understanding regarding this, once the number one type of service that we provide, that an audit firm provides, is the audit service, when in which we audit the normal 12 months financial statements of the company. All the syllabus in AAA that we have studied, it relates to the 12 months financial statements. The identification of the risk within the financial statements, the preparation of the audit report, how to provide an audit opinion, the criticism of an audit report, then making substantive procedures, the internal controls, relying on the work of others, materiality, using the RAP model, all the things that we have studied, it was in regards to the audit of 12 months financial statements. In essence, or at the same time, audit firms have to make a lot of money. They have to pay the trainees, they have to pay the managers, the partners, the senior managers, all of the people within the audit firm have to be paid. So audit is not the only thing that an audit firm provides. Audit of the 12 months is not the only service that an audit firm provides. They also provide different types of other services. And what are those services? They are usually linked with the two types of services: assurance services, in which, just like the 12 months financial statements, in which we used to provide the moderate level of assurance or a reasonable assurance, you call it, and the other one was a limited assurance. We know the two different types of assurances. In the audit of 12 months financial statements, we provide a reasonable assurance. When we talk about all the other services in which we provide an assurance, there are four types of services in which we provide assurance: the review of interim financial statements. This means 6-month financial statements account. How do we audit these or review these? The due diligence review, examination of prospective financial information. I have always told within my syllabus, within my course, that this is the most important area within other audit related services. The examiner is always surely going to ask an other services question within the exam. And if the examiner is going to ask audit related services question or other audit related services question, there is a 90% chance that within the exam, the question will be related to this portion: examination of PFI information. So the last type of service is social, environmental, and information review. Mostly these are two types of report: the integrated report and the sustainability report, which used guys studied within SBR, strategic business reporting. So these are the types of services in which we provide an opinion. Now, what is the basic difference between an audit of 12 months accounts? And because in the audit of 12 months accounts, we are also providing an opinion. At the same time, within these services, we are also providing an opinion. What is the basic difference? There is only one difference. When we are auditing the 12 months accounts, we would only provide a reasonable assurance, or in other words, our assurance will be positively worded. What is meant by the word positively worded? This simply means that we provide an answer to the user of the financial statements, and in our sentence, we do not use the word not. The word not is not used within a reasonable assurance. What this means is that our report will be worded in such a way in which we say, we have audited the 12 months accounts of this XYZ company, and at the same time, the financial statements give a true and fair view according to the IFRS and IAS standards. But in the case of other assurance services, the difference is simple, that we provide a limited assurance, or in other words, we provide a negatively worded assurance. What is meant by the word negatively worded assurance? We do not provide a full level of assurance. When we use the words that we have audited the company and the financial statements are free from material misstatements, the user will place a higher reliance upon our audit report. But when I'm talking about a limited assurance, we are just telling the users, we just skimmed through the financial statements. We just skimmed through the information that you requested us to audit. We did not provide so much detail. We did not do so much detailed procedures the way we did upon the 12 months financial statements. Within 12 months financial statements, we identify the audit risk. Then we perform the procedures. Then we provide an audit report. Before the audit report, there is an internal control review. So this much detailed work is only done within the audit of 12 months financial statements. Whenever we are providing other assurance services, we do not perform these much of detailed procedures. If you remember the procedures correctly, the 12 months financial statements procedure in the previous section A question of March, June 2023 are clearly stated were A, E, I, O, U. What were these? Analytical procedures, inquiries of management and third-party confirmations, inspection of documents and the assets themselves, observation of the internal controls, and then re-performance and recalculations. All of these procedures are performed within the audit of 12 months financial statements. But when we talk about other assurance services, we only this is not limited to, but we mostly only perform two major procedures. That is the analytical review and inquiry of management. That's it. Mostly these are done. In the case of examination of prospective financial information, we may move towards inspection of future information, inspection of the past bills of electricity, utility bills that the company has been paying. But overall, the procedures, the work is less detailed when compared to the audit of 12 months financial statement. Because of this, we provide a negatively worded assurance in the case of other assurance engagements, these type of engagements. And what are the exact words that we used? That during the audit or during the review, nothing has come to our attention which would let us believe that there would be any error here. Remember the difference within the words. In the 12 months of financial statements audit, the reasonable assurance audit, we use the words that the financial statements are free from material misstatements. We are providing a positively worded assurance. The user will play a higher reliance. But in the case of assurance engagement, all the other assurance engagements, we are only providing a negatively worded assurance. The words are, nothing has come to our attention which would make us believe that there is an error here, or these are not in compliance with the required standards. So the difference within the words would play a very high role when the user is playing reliance upon our words. Here, the user will play reliance, but he will know we have not performed so much detailed work because we are providing a negatively worded assurance. But when a user is playing reliance upon our positive words, he will place a high reliance because now he knows that we have done much detailed work here. Now, the audit firms cannot provide reasonable assurance in case of these. They cannot provide that. In the code, it is clearly written that in the ISAs, the International Standards of Auditing, it is clearly written that the auditors can only provide limited assurance for these kinds of services. Reasonable assurance can only be provided in one sort of service, that is the audit of 12 months financial statements. As I said before, The rest of the assurance engagements are divided into two categories. One where we do provide an opinion, and the other one where no opinion is provided. The client or our client for which we are doing some work, they just tell us these are the things that I need to find, and we just perform some procedures to check whether what the client is saying is true or not. What to check whether what the client wants, can we get that information or not. We don't provide an opinion. For example, in the case of a fraudulent activity, if the client is saying just identify the person who did the fraud for me and how much amount of loss did I incur, now I just have to find that amount. I don't have to provide an opinion that whether a fraud did occur or not. Opinion is not to be provided. The client has identified that a fraud has occurred. Now, my responsibility is just to let the client know what was the amount of the fraud and who actually did the fraud. That's it. I don't have to provide any kind of opinion. And what is meant by the word opinion? Opinion means that the given subject matter, or in other words, that the given 12 months financial statements, are they correctly made or not in accordance with IFRS and IS? This means an opinion. In the case of other assurance engagements, we are also providing an opinion, whether the interim financial statements give a true or fair view or not, whether the due diligence, you should acquire the company or not, whether the target company should be acquired, or in other words, whether the target company's financial statements should be relied upon or not. Now we are providing an opinion. Examination of prospective financial information. Are these prepared correctly or not? The word yes or no, we are providing an opinion in these cases. But in the case of agreed upon procedures, we agree before acceptance of this engagement with the management. What do you want? What information do you need? We will apply the procedures, whatever procedures we need to apply, and we will give you that information. That's it. We are not going to provide you an information. We are not going to provide you any sort of opinion upon this information. That is the only difference between assurance engagements and agreed upon procedures. But in my course as well, I have emphasized upon this specific terms that one thing is very important for the exam. If you want to make sure that you can pass the area of other related services, then focus upon two things mainly, because mostly the examiner is going to focus upon these two things within the exam. Number one, the PFI information. This is very important. Within PFI, always remember the types of procedures that can be performed. At the same time, always remember the acceptance procedures. At the same time, always move towards this as well. Always cover up this as well. Fraud investigation. These both areas are very important for the other audit related services. Yes, questions from other areas can also be asked. But if you have knowledge about these two areas, you will be easily able to solve the questions of these areas as well. Okay. So coming towards the main topic, which is the question within the exam. What does the question say? The question says that you are a manager in Gloop and Corporation, a firm of chartered certified accountants which offers a range of assurance services. Great. I am a manager in this firm. The managing director of Slander Corporation. Slander Corporation is going to be the client, who is not currently a client of Gloop and Corporation. This company which is going to contact us, it has not been our client since so many years, or it has never been our client, has contacted you to request to undertake an independent review of a cash flow forecast for Slander Corporation. Now in March-June 2023 exam, the examiner asked the question for other audit related services from the area of PFI information or prospective financial information. The client has prepared a cash flow forecast and we have to review it. We have to perform the procedures upon it to determine whether the given information is free from material errors or not. The following exhibits available on the left hand side of the screen provide relevant information. Exhibit number 1 says meeting notes. We have done some sort of a meeting. The exhibit number 2 relates with the cash flow forecast. The actual cash flow forecast has been given to us. All right, now let's move towards my own software, because I've copied and pasted all of these requirements within my software so we can easily work through those. Obviously, within the exam, you will be working using these all exhibits and solving the question. But for now, let's move towards my own software. Moving towards the software. So coming towards the question itself, what are the requirements of the question? The requirement number 1, the 25 marks, obviously within the exam, the 2 questions of section B will be divided into 25 marks each. Each question will have 25 marks. And within each question, there will be 20 technical marks and 5 professional marks. Now the criteria is same, but here we do not reply to an email, here we do not write an email, here we do not calculate the materiality within question number 2 and question number 3 to get professional marks. But the way of explanation, the grammatical usage of the sentences, or in other words, the technical usage of the words, the usage of the technical words, that counts. For example, using the word inspect would be given more professional marks than using the word check or review. Use the technical words within the exam to gain the professional marks. That is a very easy way to gain professional marks within question number 2 and question number 3. Now coming towards question number 2, sorry, the part A of question number 2, what does it say? Using exhibit 1 only, this means this exhibit, meeting notes, I have copied these. Evaluate the matters in respect of quality management to be considered by Gloop and Corporation before accepting Slander Corporation as a client of your firm. All right. So basically, the examiner is confusing us with two requirements. Within the course, when we talk about other audit services, we have always talked about the acceptance procedures for any type of audit services. For example, if we are checking the acceptance consideration for PFI information, we used to check the number of period covered within the acceptance, the number of period covered within the forecast, because that determines how much riskier the forecast is. The lengthier it is, the more risk there is. You should not accept this type of engagement. At the same time, we also used to check the users who will be relying upon it, the distribution of the company, whether it will be a limited distribution or a general distribution, because whenever there is a general distribution, more users will be placing reliance upon your audit report, review report, and hence it is more riskier. So we used to look at these acceptance procedures before accepting the PFI information. But the examiner has clearly stated, look at specifically the quality management areas. Now, within quality, what was quality management? If we talk about the quality management, what was it? If I come towards the ethics and professionalism area of the syllabus, ethics and professionalism area, if I divide the professionalism just like I did within the section A question, I told you that professionalism is divided into 3 areas, MAP. Within P, there is practice management, and within practice management, there is one area which is known as quality management. So quality management questions were related clearly with ISQCM 1 and ISQM or QCM, ISQM 2. What were these standards? These standards told us that whenever an audit has been completed, always check it. Always review your audit, whether all the work performed completes the risk or not, whether you have obtained sufficient and appropriate evidence or not, whether appropriate level experienced people were employed for risky areas or not. For example, what if a junior is reviewing other juniors' work? This is not an appropriate way to do it. What if a junior is doing, let's say, IS 19 employee benefits? It involves a lot of risk. It is the estimate of management, and whenever there is an estimate of management, this means that a senior person should do it who has more experience, because they will be able to completely audit or obtain sufficient and appropriate evidence regarding the management's estimates. So these are the areas we used to look at when we were developing the answer for quality management. But here the examiner states, look at specifically those areas which you think that they would affect the quality if you accept this engagement. Now, instead of reviewing an audit that has already been done, which we studied about, the examiner here is stating, this is not the question in which we review an audit which has already been done. No, the examiner is stating that yes, before accepting, what are the things that you can identify which would in future, during the review of this PFI, during the audit of this PFI, would affect the quality of this review. This means you would not be able to obtain sufficient and appropriate audit evidence. So this is the question that we need to solve. We need to solve it in the future tense, that we need to look into areas which I think specifically as a student that these areas will hinder the quality of this review, hinder the quality of this audit. So coming towards the question itself, obviously I only have to use the exhibit number 1 to solve this question. This is the exhibit number 1. We will read all the information and identify areas which could hinder the quality in the future. Now, during the quality management, what were the areas we used to check? Time, whether enough time was available to complete the audit, because if there is less time, this means that there is higher risk that we did not obtain sufficient and appropriate audit evidence. We would not have enough resources to complete the audit. The time is a resource. If we don't have enough time, this means our resources are lacking and we would not be able to obtain sufficient and appropriate audit evidence. At the same time, the level of people involved within the audit, this quality is also hindered by this. At the same time, management's on integrity. If management is not honest and is not straightforward and honest, this simply means that they would not provide us the required information. They would lie upon our face. They would give us wrong information. Hence, we would not be able to complete the audit using obtaining sufficient and appropriate audit evidence. So integrity of the management also affects the quality of an audit. At the same time, the ethical issues, because if there are ethical issues, and what were the ethical issues? Issues that affect us meeting the fundamental principles of ICOP square. At the same time, threats that arise to objectivity, or in other words, SAFIM threats. If there are threats, this means that we are not independent of the client, or we were not independent of the client. So this also hindered the quality of our audit. So now within this question, we will again look into these matters, but now from a different perspective. We will see whether for this specific audit, do we have enough time in the future or not? Because if we do not have enough time, this means we lack our resources. Time is a resource. We will need to have enough properly skilled, experienced people to complete within the time. And so we can obtain sufficient and appropriate audit evidence to complete this audit within the time. At the same time, if the people involved within the audit are not that great, if we still have to make a team, then we need to make sure that the team is appropriate. If the client's integrity is not correct, this means that during the audit, they would not provide us relevant information, which would lead us to making incorrect opinion, giving an incorrect opinion upon this PFI. So we need to look at these matters now. We will identify these matters one by one. Remember, this question is not regarding the acceptance. This question is regarding the acceptance, but in other sense. All the issues that can hinder the quality of this review in the future, those are the issues we need to identify at max. Not the actual acceptance procedures. If we find any type of issue that also relates to the acceptance procedures of PFI, which we read in the book, then we will identify those as well. But our main goal will be to identify the quality issues that will affect this audit in the future when we will be actually doing this audit. So coming towards the question, the company information states that Slander Corporation, a non-listed company, operates 20 coffee shops within large airport terminals. The company is owned and managed by Aaron Slander and a financial controller already. All right. He is an owner manager himself, Aaron Slander, and a financial controller. Both of these people are managing the company and the rest of the people are employees. Typically, Aaron takes a small salary from the company. All right. He takes a small salary. So there is no risk here, and extracts most of his income from the business in the form of dividends. Great. No issue in that. We don't have any issue. This would not affect the quality of our audit. Aaron is looking to retire and would like to extract $1 million from the company. Okay, so this may create a threat for us, because now Aaron is looking to retire and he wants to take out $1 million from the company. So there can be a risk that this forecast that you are making, it might be possible. I haven't read the full question up till now, but it might be possible that you are making this forecast to take a loan from the bank, and whenever that loan comes to the company, Aaron will take that 1 million and retire from the company, and then the company will have no more funds, because the loan acquired against this forecast will be used by Aaron himself for his personal benefits, and the company might go bankrupt. The bank may not be able to obtain the interest and the loan back from the company. So this might be a risk. But again, I have told you all that never write the risk straightforward. Always try to identify evidence from the question itself. Is whatever story just came to my mind, can this story be related to the scenario or not? That is a question. The company operates, this is a risk, so let me identify it right here. We will think about it. Do we need to write about it or not? The company operates from leased premises, and the majority of remaining assets are fixtures and fittings, as the inventory of food, beverages have a short shelf life, and the company does not offer credit to customers. All right, they don't offer any kind of credit. This means no receivable balances. The brand name, all right. Aaron has suggested he extract funds of $1 million from the company by selling to the company the brand name of Slander. All right. How will he extract $1 million? On what basis he is deciding that I will take out $1 million from the company when I retire? On an assumption that this brand, which Aaron made himself, this brand will be sold to the company that he owns, and then he will retire from the company himself. The company will keep on using this name, Slander Corporation. Okay. This would give the company the right to trade under Slander Corporation's brand, okay, which he believes has a significant value. He has decided to sell the brand name for $1 million, we know that, to the company despite an external valuation of $100,000. So basically, my assumption was correct. What was my assumption? Maybe Aaron is making this forecast that we will be auditing to gain loan from the bank, and when the loan is approved from the bank, the company will take the loan, give it to Aaron. $1 million will be given to Aaron, despite the fact that this brand only has a value of $100,000 by a professional valuer who actually valued this brand's value. So Aaron is basically trying to engage in a fraudulent activity here. This is point number one. This will affect the quality of our audit, because now we need to make sure whatever Aaron is doing, we do let the bank know in one way or another way that this might be the risk in the future. So this is the point number one that I will write down. And this relates to the integrity of the management, because Aaron, who is a part of the management, they are not being straightforward and honest. They are trying to indulge in a fraudulent activity. Due to the company's current cash position and existing borrowings, this would require the company to obtain further financing through a loan. As part of the finance application, there will be an additional funding requested for expansion of the business. So now we clearly know that this company is going to acquire loan from the bank just to buy this brand name from Aaron, where for $1 million, whereas an external valuer has said, no, Aaron is lying to your face. This brand only has a value of $100,000, not $1 million. Whereas now you are going to pay $1 million to Aaron for a brand that is only $1 million, $100,000 of value in the market. So this is clearly a fraudulent activity. This raises the questions upon the management's integrity itself. Okay. Coming forward, that is the issue number one. Let's identify more issues. The profitability, the second paragraph states that business performance. The profitability of Slander Corporation has significantly reduced over the past 2 years as a result of decreased travel during recent economic downturn. With the company making a loss in each of the 2 previous years, great, we know this information. In the last 2 years, the company has struggled to make payments to suppliers on time and has suffered deteriorating relationships as a result. In the last few, payments to creditors have been severely delayed as a result. Slander Corporation's main supplier has implemented a cash on delivery policy for any purchases made by the company. This information will be relevant to audit the payable section within the cash flow if the examiner requires any types of procedures. At the same time, the going concern status of this company. Aaron is confident that revenue, profits, and cash flows will return to positive results obtained in previous years. He has identified 5 sites for new coffee shops at smaller airports and is confident he can negotiate a good deal on leases for the sites at lower than usual rentals through his connections within the industry. There is no ethical time bar limitations or ethical threats or management integrity questions that we might have had here. So this information was irrelevant to us within Exhibit 1, Section A, Part A question. So moving forwards, the loan application itself. Slander Corporation has obtained a funding offer of $1.5 million from the bank. Great. This is the loan that they will be taking. This funding offer is subject to submission of a satisfactory business plan accompanied by an independent assurance report on the associated cash flows. He believes that if the proposal demonstrates the expansion of the business by the opening of new coffee shops in smaller airports, the bank does not need to know the brand is in his own name. No, the bank needs to know that the brand is under the name of Aaron, and Aaron is going to take $1 million in order to give this brand to this company. So this is going to be a big issue, whereas Aaron is saying, no, the bank does not need to know that. Bank needs to know this, because only upon this, when the bank knows that directly $1 million will be given to Aaron to buy this brand, will the bank be giving out this $1 million loan to the company then? Because $1 million will be straightforward given to Aaron. They are lost. There is no return generated upon that 1 million. You are not generating any types of profit upon that 1 million. You would only be using the remaining 0.5 million or $500,000 to generate more profits. That's it. The remaining 1 million is gone from the company just like that, because Aaron will take it in his own pockets and give the brand name to the company under which the company already trades. He would like for the process to be completed as soon as possible, as he wishes to be retired by 30th of September 2015. What is the date today? That is the question, the major question. What was the date today? It was 1st of July 2015. July, August, September. We only have 3 months to complete this PFI. This is surely a time bar limit upon us. We need appropriate people, skilled workers, competent enough to complete this review and obtain sufficient and appropriate audit evidence within the given time limit. And it would be difficult to do that, again hindering the quality of the audit in the future. So this is going to be my point number 2, which I'm going to write. This is going to be my point number 2, which would affect the quality of the audit in the future. The next one, the audit. It says Aaron expressed his frustration with the current auditors. Okay, Aaron has said that he is frustrated with the current auditors of his company. I don't know why. They do not have the same confidence in his business as he does. Oh, because the current auditors are saying that his business will not be able to continue in the foreseeable future, or this business has any kind of going concern issues. So maybe those auditors are right, whereas Aaron is saying that the auditors do not believe me. The auditors say that my company will not be able to continue. Yes, you need to be motivated, but facts are facts. You cannot ignore the facts. Those auditors have been auditing your company for far too long. They know that your business has been making a lot of losses. They know that you don't have enough cash to cover up your short-term liabilities. They know that you don't have enough motivation or enough business development to continue the business in the foreseeable future. So that is why the auditors are saying that you may not be able to continue. That is why the auditors do not have confidence in your business. And whereas Aaron is saying, oh, they do not believe in my business. So what is Aaron saying ahead? And Aaron intends to appoint Gloop and Corporation, our firm, as the auditors of the company if the loan application is successful. Wow. So basically what Aaron is doing, there are two problems here. Number one problem is that Aaron is threatening their existing auditors. Aaron is threatening their existing auditors, saying that if you do not bring back your confidence within my business, I will take away this audit service from you and give it to this firm who is going to audit the PFI. One thing is here, he is threatening the existing auditors. This means that the existing auditors are being given an intimidation threat. So we need to raise that point, because this again raises a point upon the integrity of the management. The second most important thing is this, that Aaron is saying that if the loan application is successful, and my question is from you guys, when will be this loan application successful? If we, the ones who are going to audit this PFI, if we say that this PFI is correct, then the bank is going to say, okay, this PFI is correct, nothing is wrong in this PFI. So we are going to decide that we give loan to this company. We give loan to Aaron's company, Slander Corporation. And if this loan is given, only then we will be appointed as the auditors of this company. So Aaron is saying, get me the loan, take the audit service, and I'll pay you for the audit service. So now this is going to create the number one issue in this paragraph was existing auditors are being given an intimidation threat. Number two issue is that we now have a self-interest threat within the company, because in order to get this audit service, in order to get more fees from Slander Corporation in terms of providing the audit service of 12 months financial statements, we would have a financial interest within the company, and this would impair our objectivity. We will be biased towards making sure that Slander Corporation gets this loan, so that in the future we get the audit service. So this is the number two issue that I identified within this paragraph. The next thing, in addition, the assurance team will be entitled to free food and beverages from any of Slander Corporation's coffee shop for life. If that is the case, this means that the audit team, Aaron is saying that if I get the loan for your whole life, the team who will be reviewing this PFI will get free beverages and services from any of the coffee shops of the company. Now, the problem here is that the code of ethics clearly states that these come under the gifts and hospitality from the client. Basically, if you will go towards the practical life of an audit, whenever you go to the client, they do give you some money or they do give you some food to eat when you are there as well. That is known as hospitality by the client. Now, the code of ethics clearly states this, that gifts and hospitalities can be accepted. Gifts and hospitalities, these things can be accepted by the client if they are of a limited, small, or the more professional word is trivial value, trivial and inconsequential. Now, free food and beverages, if we talk about during the period of actually performing the PFI's audit, that is considered trivial because the auditors would only eat like $1 or $2 at most at one time. So it is a small amount. It is not a big amount. But when you say that you will be given free food and beverages for your whole life, this simply means that when you aggregate it over the life of that person, it would become of a non-trivial value. And at the same time, this offer is being given to you to make sure that you approve the PFI, to make sure that you don't identify any kind of mistakes with the PFI. So this has a consequence as well. This is consequential in a way that Aaron Corporation is trying to promote, that you let us have the bank's loan. You say with your eyes closed that the PFI is correct. So the banks give us a loan. Only then we will give you this free food for life. So Aaron is giving you this gifts and hospitality so that he can make a consequence of this gifts and hospitality upon your audit. So there is a consequence. Again, this is a number 3 issue from this paragraph. This gives rise to again a self-interest threat. And this cannot be accepted by Aaron under no case. All right. So these are the issues which I have identified. Now, these were the issues which I identified from within the scenario. Now, before continuing towards the answer, I've already told you all that some of the issues are always within your mind. Some of the issues are automatic, like they are by default going to become an issue. Whenever you are accepting a new client, there is always the issue that because you have never performed any kind of independence check before. What is meant by the independence check? This means that before accepting the client, make sure that you will be complying with all the ICOP square principles. There will be no SAFM threats. You need to comply with these. So whenever there is a new client, Code of Ethics tells us before accepting, make sure that you comply with this. This means that you are independent of your client at the same time. You are independent. So because this is a new client, this is also going to be an issue. We need to make sure that we are independent of the client. We can write upon this as well. At the same time, there was a default issue. Whenever, let's suppose this, you are auditing XYZ. You are auditing XYZ Corporation. This is a company that you audit. You audit 12 months financial statements of this company. You have been auditing this company for, let's say, 1 year, 2 years, 3 years, 4 years, whatever the case is. But because you have performed so much detailed procedures, you have a detailed understanding of this company, XYZ company, because you were the auditors of 12-month financial statements. Even if you were the auditors for like 1 year, you have only audited this company for past 1 year. This means that, but still, you have performed detailed procedures during the audit of 12 months financial statements. So you now have much detailed understanding of this company. If, for example, XYZ Corporation needs to review its PFI information from any of the auditors, it does not choose the existing auditors who has the most understanding of this company. They choose another audit firm to perform this service. This means that maybe XYZ Corporation is choosing another audit firm due to the fact that the existing auditors have too much understanding and they will be easily able to identify any types of mistakes within PFI, whereas the new auditor that XYZ Corporation is selecting, they will not have enough understanding of the company. They will not have enough detailed understanding of the company. They have not been involved in any of the detailed procedures performed. So they don't have enough detailed understanding, and it will be difficult for this new audit firm to identify any kind of PFI errors. So here, Slander Corporation is not selecting its existing firm, existing auditors. Rather, they are selecting a new auditor. There may be a reason for this. What is the reason? The number one reason is they are trying to threaten their existing auditors. And the number two reason is this: that because the existing auditors will have a much detailed understanding of the company and they will be in a better position to audit this company, whereas we will not have detailed understanding. We will not be able to identify the errors within PFI so easily compared to the existing auditors. They would be able to identify any types of errors with much ease. So this is also an issue. So if I look at all of the issues that I identified, the number one issue, now I need to divide these issues between headings. Within the exam, I just cannot go ahead and write down my answer. I need to write down the headings appropriately. This will give me professional marks for communication as well. If I come here, professional marks will be awarded for demonstration of skill in analysis and evaluation, professional skepticism and judgment, and commercial acumen in your answer. So overall, these 5 marks will be given for these 4 areas, these 3 areas overall. But at the same time, I need to develop a good answer. I need to write down correct headings for section number 2. That is question number 2 and 3. And the section number A was the same case. I used to write down headings for each of the risk. And but in this case, write down headings because it makes this easier for the examiner to identify what you are going to write about. So if I have to divide all of this question or within the headings, how would I try this? The number one issue relates with the management's integrity. So this would be an integrity issue. The number 2 issue that I identified relating to time, this relates with professional competence and due care, some sort of that issue. Just this relates with professional competence and due care. So I can write it down right here and give a heading of time resource or resource only within my answer. So this is the number 2 issue. If I come towards the third issue, existing auditors is being given an intimidation threat. This is not an ethical issue because you're not facing any kind of ethical issue. The existing auditors are being threatened. So if they are being threatened, this means that the company is not straightforward and honest. So this also is an integrity issue. So now within integrity issue, there are 2 points. I have 2 points within integrity issue. If I come towards the self-interest threat, this is an ethical issue. If I come towards the self-interest threat regarding gifts and hospitality, this is again a self-interest threat. So within self-interest threat, I also have now 2 points. If I come forwards towards these 2 issues that I have identified, again, the new client issue is an ethical issue again, whereas this new audit issue is the integrity of management's issue, integrity of the client's issue. So within integrity of the management, I have 3 points. Within ethics, I have 3 points. And alone within professional competence and due care issue, I have 1 point. So if I come towards the question and check out the marks for this question, I will have a total of 12 marks. So if I divide this by the number of issues that I have identified, 331, this is 7 issues in total. How much would I be given for each of the issue? This gives me approximately round about 1.5 marks, I think. Let's check. 12 divided by 7 is equal to, yes, 1.5 or 1.7 marks for each of the issues that I have identified. So let's continue to write it down, write down the answer and give a heading of question number 1. I'll give the heading of part A. And give the heading, first of all, let's start with integrity of management. Integrity of management. Give this heading and write down all the points that relates with integrity of management within this heading, within different paragraphs. So coming towards this, remember, there is no short way of how to actually solve the answer for this. There are no steps, but just remember the basic concepts. 1 marks is equal to 1 valid point. That's it. So coming towards this, the first issue was relating to the brand name. So we will talk about this first of all. Aaron, what was the name of this person? I need to AARON. AARON. Aaron has determined that he will retire from the company and hence the brand which he created would not be under the ownership of the company. Hence, he wants to sell this brand name to the company for consideration of $1 million. I'll just add a dollar sign here. $1 million. The fact that the same brand was valued at $100,000 means that Aaron might be involved in a fraudulent activity, as he may only be availing this loan from the bank to finance his lease, finance his purchase by the company, and I can also add down that he might not be confident in the business as well, so he's trying to take an early exit, and the company may not be able to generate the funds or cash flows, profits to return this loan to the bank. Hence, this raises a question upon the management's integrity. Aaron's integrity. That is the point number 1. We have already written down about it. So let's come forwards and write down the point number 2 within the same heading of management's integrity. That was the existing auditor's intimidation threat. So I'll write down. Aaron has also suggested that he dislikes, what was the correct word used? He is frustrated. He is frustrated with the existing auditors, and hence he would like to transfer this audit service to Gloop and Corporation, which is us, Gloop and Corporation, as the existing auditors are not confident in his business. This means that the existing auditors may have identified issues in the financial statements regarding going concern status, going concern of the company of Slander and Corporation, and hence, in order to intimidate, in order to threaten existing auditors to follow the management's assumptions, regarding the business, he is trying to create this intimidation threat to the existing auditors, that if they don't, then this service will be removed from them. Hence, again, as an intimidation threat is being raised, as an intimidation threat is being raised by Aaron, this again raises the question of his integrity, and the same issue may be created by him when Gloop and Corporation will be reviewing the PFI. So the next part that we identified under integrity related to why Aaron Corporation has not given this to the existing company, and to us, to the existing auditors and to us. So at the same time, an integrity issue of the management, an integrity issue. No, at the same time, the question upon management's integrity. Oh, the questions upon management's integrity is also raised, that why the existing auditors have not been given this service of PFI, as they would have the detailed knowledge, and understanding of the company, understanding of slander and corporations. Always use the name of the company itself, not just company, understanding of slander and corporation. Hence, they would be in a better position to properly obtain sufficient and appropriate evidence whether the cash flow forecast is appropriate or not. The management or Aaron may have also not selected the existing auditors, as Aaron knew this and knew that cash flow forecast contains issues which would be easily identified by existing auditors. All of the above, I'm just talking about the integrity of management's part, all of the above raise the question that there is a higher risk that the cash flow forecast is highly misstated, in order to make sure that the loan application will be accepted by the bank. That's it. These are only the issues that we identified within the management of integrity of management's part. Now coming towards the next issue. What was the next issue? The next issue relates with the time that is available. So it raises the questions upon the resources available, or in other words, professional competence and due care. So I'll give a heading of professional competence and due care. Now, obviously, within the exam, you are a student. Properly identifying this, I might also be wrong within stating the heading that professional competence and due care. It might not be an issue of professional competence and due care. The heading should only have been given resources. So within the bracket, I will write down resources. Then I'll start to explain this. So if I'm wrong about this, the examiner knows that I'm talking about resources. Coming towards this part, I'll state that before acceptance of any engagement, the auditors should make sure that they have the required resources to obtain sufficient and appropriate evidence and to complete the engagement in the required time. Here, Aaron has stated that he wishes to retire by 30th September 2015, and hence would like us to complete the audit, complete the review and report provided as quickly as possible. Hence to properly obtain the sufficient and appropriate evidence, Gloop and corporation should ensure that appropriate, that skilled and experienced staff is used on this engagement before acceptance, is used on this engagement, and it should be assessed. It should be assessed whether we have the staff which has the level of skills and competency required to complete, required for this engagement, That's it. That's all I need to write here. So moving forwards towards the next part, we have the issues relating to ethics itself. So ethical issues, I'll give a heading of ethical issues and write down all the self-interest threats and all the issues in relation to this. But before writing any scenario related issues, I have another issue with me that was relating to the new client. So I'll write it down first. As Slander Corporation is a new client, which means that no independence checks would have been performed before. Hence, it needs to be ensured that before acceptance of this engagement, Gloop and Corporation ensures that they will be independent of Slander and Corporation and meet all the ethical requirements and the fundamental code of ethics before acceptance. That's it. That's all need right regarding this specific point, which was not related to the scenario. Now let's come towards the scenario related points. The number one point which I identified is that the self-interest threat of a financial threat that this audit service will be given to us if the bank approves this loan application. So I will need to write about it. And a self-interest threat to objectivity is created by acceptance of this engagement as the management, as Aaron Corporation has suggested that if the loan application is approved from the bank, then he would give the annual audit service to Gloop and Corporation. Gloop and Corporation would now have a financial interest within the PFI information to ensure that the loan application is approved. Hence, Gloop and Corporation would now have a financial interest within the PFI information to ensure that the loan application is approved. Hence, to avail the annual audit service as well. Hence, the objectivity of Gloop and Corporation will be impaired. Now, obviously, I need to give an appropriate safeguard relating it, but where I see it, there is no safeguard to this information. There is no safeguard. The only safeguard that I see is that this should be rejected, like what Aaron has told us, that he is probably going to give us the annual audit service if the loan application is accepted. But this is such a high threat in my eyes that there is no safeguard for this, which I think it is. So instead of writing down the safeguard here, there are other self-interest threat as well. So let's see whether we can combine all of those self-interest threat. The second number self-interest threat is regarding the free food and beverages for life. Another self-interest threat is raised as Aaron suggested that if the loan application is completed, if the loan application is approved, then the team of auditors who review the PFI would be given free foods and beverages for life. Now, obviously, I'm going to use the words of the Code of Ethics itself. What were the words? Gifts under the code, gifts and hospitality by the clients can be accepted only if they are of an inconsequential and trivial value. The free food and beverages for life would be in aggregate of a high amount. Hence, this value of aggregate would not be trivial and highly consequential upon the PFI. No, highly consequential for this review. Hence, now obviously I'm not going to give a safeguard directly to Aaron, directly for this situation. Do we have any type of other threat that we have not written down up till now? A threat might also arise as because we will be the future auditors of this company, and at the same time we are reviewing this PFI. And Aaron is saying that if the loan application is approved, this means that Aaron is some sort of suggesting that we should make sure that the loan application is approved. This might be an advocacy threat as well, because now we will be trying to make sure that the application is approved. So we will promote the financial position of this client to the bank to make sure that position is approved. But that would only arise if we are the auditors of the company, if we become the auditors of the company. So that is a threat that we can also write here, that this would also create an advocacy threat, because now in order to make sure that the loan application is approved and we actually avail these 2-3 different opportunities that we are being given by Aaron, we would promote the business of the client in front of the bank, and this would raise advocacy threat. And under the Code of Ethics, firms are not allowed to do this. Firms are not allowed to accept this type of engagement. But instead of going towards that and wasting time for this part, because we have already written down so much, instead of going towards that as well, I would not write it within the exam. But this is the point. Just keep in mind that this is a point that you can also write within the exam. So coming towards my final marks for this specific ethical issues that I have identified, I would write down: before acceptance, Gloop and corporation will need to ensure that safeguards are put in place to reduce the above threats to an acceptable level. But the impact of these threats are so significant that it might not be possible to reduce these threats to an acceptable level. Now, why am I writing this line? Because specifically, if you look at the first thread, that you need to check the independence, we can check the independence. That is not much of a big threat. But if you look at the second number threat and the third number threat regarding self-interest for food and beverages, hospitality and gifts, and if you look at the self-interest threat of giving us the audit service, this raises such a high threat that there is no safeguard within the book. If you look at the book clearly, if you look in theory in black and white, there is no such safeguard that these two threats can be reduced to an acceptable level. I mean, what sort of threat safeguards can you give? One safeguard is reduce, politely decline this first service, that we do not need the audit service from you and we will be auditing the company with high regards and maintaining professional skepticism. We can write all of this down, but again, during the review of PFI, somewhere in our mind, we will try to make sure that we do get the audit, because that is again extra fees for us. If we audit the company, we would get the fees. So I think that there is no such safeguard that can reduce these threats to unacceptable levels. That is why I'm writing this line. Within the exam, remember this, many of the students try to be so perfect within the exam that they always try that my answers are always matching with the examiner's response within the kit. But that is impossible to do so. You cannot write a 3 hours exam using the words of the examiner himself, writing perfect answers. Perfect answers would require almost 5 to 6 hours. Within 5 to 6 hours, you cannot complete the exam. The exam timing is only 3 hours for you within AAA. So if you move specifically towards this question, I think there is a reason to give the examiner or explain it in a better word to the examiner. The examiner clearly states that your answers would not match my answers. That is true. But if you give the reasons to me why you wrote something, and if that reason complies with the things that you read in the book, then I'll give you the marks. If that your reason complies with the scenario itself, I'll give you the marks. I might not give you for the marks for the things you have written wrong, but if you explain them right, I'll give you the marks for that. The examiner has clearly stated this. So if we move towards this, my point is that there is no such safeguard for this. So the examiner will know why I'm saying this, because I have explained it above so much that because of these threats, no threats would reduce these no safeguards would reduce these threats to an acceptable level, because there are no such in the book that relates with these kinds of issues. These are some new types of issues, out of the world issues. So basically, based upon this, whenever I'm deciding upon the acceptance of any kind of assurance engagement, whether it is a 12 months audit, whether it is any type of assurance engagement, obviously before acceptance, I do these types of researches, the acceptance procedures. If majority of the acceptance procedures are leading me towards one thing, that no, do not accept this engagement, there are a lot of issues. For example, I identified 10 points, and out of those 10 points, 10 points are leading, 6 points are saying that there are issues. The rest of the 4 are saying that we can manage these, we can apply safeguards. But in this question, there are so much issues. There is only one issue that you can solve. What is that issue? That issue is the time itself, the resource. You can solve this issue by having much skilled and competent workers, but then this is just one issue. The rest of the issues related with integrity of the management, the second issue regarding the ethics, leaving this issue, the rest of the issues, I don't think there is any kind of safeguard that can reduce this threat to an acceptable level. So my answer, yes, I have to give a conclusion whether we should accept this engagement or not. So my conclusion will be that I'll give a heading of conclusion within my answer. I'll give a heading of conclusion, and within the conclusion, I would state that based upon the above points raised, the threats are so high that reducing them to acceptable level is highly impossible. Hence, this engagement should not be accepted. Now, just clear your mind for 1 second and think about this. You are going to audit a company that is intimidating their past auditors. There are high chances that they would try to intimidate you as well. You are going to audit a company that is offering you something in exchange for making sure that they get the bank loan. So they are trying to create self-interest threats. They are trying to create the intimidation threats for you. They have created so much threats for their past auditors as well. And Aaron, the owner of the company is himself saying that he is frustrated with the existing auditors. What if we in the future say that there is some information wrong within the PFI? He would say the same to us as well. So his integrity is at the question. He is the top manager. If his integrity is at the question, this means that the rest of the company would not be following the controls and be correct as well. They would also not be honest. Same is the case with the ethical issues that we have identified. So based upon so much negatives, I have to give my answer that we should not accept this engagement. So this is my answer. Now, moving towards the next requirement. What is the next requirement? Again, I have already copied the requirements to my own software. Coming towards these requirements, the requirement number 2 states, before the requirement number 2, there is some sort of a paragraph. We will need to read this as well. What does the requirement 2 states? That requirement 2 states using the information in exhibit 1 and 2. Now, what is exhibit 2? Exhibit 2 is the cash flow forecast itself, this one. I've already copied this within the software. I made pictures of this and copied this within my software. So coming towards this, obviously, I have already copied this. So we can make appropriate, like use the pen to identify the correct issues. But coming towards this question, what does it say? Evaluate the assumptions used by management and the completeness of the cash flow forecast prepared, explaining why particular assumptions should be challenged and approached with professional skepticism for 8 marks. Now remember, this question is not regarding identifying any type of or making any procedures. When you are required to make a procedures, the examiner will clearly state within the requirement that make procedures upon this. You are not required to make any kind of procedures. You have to clarify that if these sales are increasing by this much amount, there is a risk about it or not. Why do you think these are not correct? Why the assumptions used by management that the sales would increase, why it is wrong? You need to explain this. So looking at these assumptions, we will identify what are the problems with the management assumption. If the management is saying that the expenses would decrease, it is not possible. This is an assumption that is wrong. If the management is saying that the revenue would increase, this is wrong. If the management's, now we have already identified within the question that our biggest supplier is saying that I will not provide you any kind of credit terms. Rather, you will only buy from me on cash basis. This means that I don't have credit terms anymore. I cannot say to a supplier that I'll buy something from you today and pay after 60 days. No, I can't do that anymore. Rather, whatever I buy, I have to pay for it as well. So based upon all of this information, I know that the company also cannot show any kind of payables that I will save cash because I will not pay to my supplier, but that is not the case. If this sort of assumption is used by the management, again, I will have to identify and challenge that as well. What is mean by challenging it? The word challenging means state that how you think management is stating this and this is wrong. What do you think management is doing wrong here? You need to explain that. Why do you think, but if management has stated that the revenue will increase by 10%, why do you think that this won't be the case? So you need to challenge it. You don't have to make any kind of procedures. Now, within the exam, remember this. This is a total of 8 marks. Identification and explanation. This means challenging it. This is for 2 marks. This means that if you identify one issue and explain it, challenge it, this means that you would get 2 marks for it. So in total within the exam, you only need to write down how much 8 divided by 2 is equal to 4 appropriate points, identify them and challenge them. This means that you need to write down 4 points at max within the exam. Now, most of the students within the exam will go, oh, I identified the sales issue. Oh, I identified this issue. I have also identified this issue. Oh, I can write about this issue as well. They will waste so much time upon this question, whereas the examiner has clearly stated, I only need your answer for 8 marks. This means you need to only identify 4 points. Even if you identify more points, don't write about it. Let it go. Let it go. Move towards the next question. Complete your questions for the required marks. Move towards the next question. Complete all of the exam for the required marks only. And then if you have time remaining, then come back towards the question. Majority of the students are not able to complete the whole AAA exam. I remember my time as well. I was not able to complete the whole AAA exam. I left behind 5 marks, but still I managed to pass the AAA in first attempt. I left behind 5 marks. Why? Because I made the same mistake. What was my mistake? That instead of moving towards the next question, when I had 20 minutes remaining, I was like fluffing around with the question that was the second last requirement. I was playing with it, that I can write down this answer as well, this answer as well. So that is a big issue. Don't do that. Never do that mistake. If you have completed the marks, move towards the next question. Moving towards this question, we have to identify the specific issues that I think there are within this forecast. So moving towards this, let's identify the issues. So coming towards the cash flow forecast, obviously remember this. Within the question, within the exam, when you are going to solve the exam, many of the students directly go towards identifying the issues within the forecast, directly towards the issues for the forecast. Like they would go and identify like cash from sales, or it is increasing by this and this much percent. No, always first understand what type of forecast has been given. If I look at this forecast, 6 months period till December 2015, and then the next 6 months. So this is 1 year, then the next 6 months and 6 months, which is 1 year, and then the next 6 months and 6 months, which is 1 year. So the forecast is for the next 3 years, and each of the year has been divided within 6 months. The number one point says that sales per coffee shop, it is for 125,000 within the first year, first of the both 6 months of the forecast, for the amount will be the same. If I move towards the second year, it increases towards 140, and this is sales per coffee shop, not the all of the sales. This is the total sales per coffee shop. And then in the third year, for each of the months, it is 160. If I come even more forwards, then the number of coffee shops have been given to me. In the first year, I will have 20 coffee shops. Obviously, within the question, when I was reading the question, it was stated that right now I have 20 coffee shops which are not able to generate enough revenue. And I have also identified within the question here, right here, that the profitability of Slender Corporation has significantly reduced over the past 2 years as a result of decreased travel due to recent economic downturn. Because of reduced travel, this means there were less customers available at the airport. And because there were less customers available at the airport, this also means what? This means that because of less customers, now I had less customers to buy the product. Less customers buying the product mean less revenue. For the past 2 years, my sales have been in the declining motion. Whereas in this forecast, I am showing that the sales per coffee shop will increase in each of the year. How is this possible? This should not be possible. First thing, this is the first issue that I have identified up till now. First issue which I have identified is this: the sales per coffee shop is increasing, whereas for the past 2 years, my sales were decreasing. All right. The second reason which I identify is that the company is saying that, obviously identified that in the first year I will have only 20 coffee shops, and then the owner has said that he has identified 5 more areas right here. Aaron is confident that revenue, profits, and cash flow will return to positive results obtained in previous years. He has identified 5 sites for new coffee shops at smaller airports. So these will be smaller airports. So now if I state this, Aaron is saying that in the second year, I will open in the first 6 months of the second year, I will open 2 new coffee shops. And at the same time, they have been added in the revenue. Now Aaron is saying that I will open the coffee shop. The day I decide the coffee shop is to be opened or it has to be made, they will be made and they will start making revenue. That is not possible. Obviously, the construction of the coffee shops is going to take a lot of time. But you have included within the forecast that as soon as the coffee shop, I decide that coffee shop should be opened, at the same time I will start getting revenue from it. No, that is not possible. And again, you are stating that these 5 new shops that I'm deciding to open, these will be in smaller airports. And if they are in smaller airports, this means that there will be low number of customers there, because there will be low number of travelers in smaller airports. So how can you say that 140 of the revenue that will be generated for the 20 larger shops that I have in other location, my existing shops, same revenue will be generated by the 2 new shops that I open. Same revenue will be generated in the future as well. Same in the future, same in the future. That is the number 2 issue which I have identified. Same revenue for smaller coffee shops, same revenue for smaller coffee shops. Okay, if I now revise the issues that I have identified within the forecast, the first issue was that the revenue is in the increasing trend. Within the forecast, Aaron is saying that my revenue will increase, whereas in the past 2 years, it has decreased. So now you are saying that it will go like this, it will decrease, and at the same time, it will start to increase. The day I start preparing my forecast, the revenue is going to increase. How is this possible? It takes a lot of time to revenue to be, first of all, stagnated for some time, and then it will start to increase. It just can't go like downhill and then above hill. No, that is not possible. So again, this is a big issue. Okay, now coming forwards toward this, coffee total sales have been given. Obviously, how will the total sales be determined? 125 multiplied by 20 is equal to this. 120, the total sales have been given here. So I do not need to focus upon the total number of sales. I need to focus upon these issues, that the sales for each coffee shop, you are saying that they will increase. Even the sales from the new coffee shops that you have involved, the number one issue is that they will be constructed and this revenue will start to come from it. Obviously, it takes time to construct. The third issue is the construction issue. And the already issue that I have identified is that you are clearly stating that as soon as you open the coffee shop, obviously they are going to generate the revenue. Construction takes a lot of time. That was the third issue. The second issue is that you are saying that the new coffee shops that are opening in smaller locations, they will have less number of customers compared with the old coffee shops that I had, because those coffee shops are in big locations, they are in big airports, whereas these are smaller locations. And you are saying that they will also generate the same amount of revenue. That is also wrong. Now let's go towards the note of this specific point. The note. Why is the revenue increasing? Maybe we will have some sort of idea from this note. Sales have been calculated based upon the average sales per coffee shop in 2013, okay, prior to the economic downturn. And now you are saying as soon as you prepare the forecast, the downturn is going to finish and the revenue will start to increase. No, that is not possible. Sales price inflation have been included approximately at 10%. Obviously, those people who have done F9 exam, they know that during the NPV calculation, we also inflate the revenues being generated. The inflation effect is being taken. So yes, you can say that you are increasing each of the sales by 10%. So let's check whether the sales are being increasing by 10% or not. So in the first year, when the sales are increasing from 125 to 140, there is a 10.7% increase. In the second year, when the revenues are increasing by, in the third year, when the revenues are increasing by 140 to 160, there is an increase of 160 minus 140 divided by 160 multiplied by 100. So there is a 12.5% increase. So first of all, if the inflation rate states that your revenues should increase by 10%, along the inflation rate, based upon the inflation rate, your revenue will increase. That is not possible. First thing, the inflation rate itself, I think, is not correct. The second thing, why in the last year you are stating that the revenues will increase by 12.5%, whereas the inflation rate is only 10%? This means the number of customers will increase. How will the number of customers will increase? So I have identified 4 issues just from the revenue itself, the sales itself. So before going forwards, let's write it down. Obviously, within the exam, I will assume that this one issue will lead to 2 marks. Even though the examiner is going to give me 2 marks for this, 2 marks for this, and 2 marks for this. But still, for the sake of completely writing down our answer, let's assume that the examiner is going to give me 2 marks. Let's write it. So part B states, we have not read what this scenario states right here. I need to read this point as well. It is now 1st of August 2015 and Aaron has retired without withdrawing a lump sum and instead will continue to receive dividends as retirement income. On this basis and having satisfied client acceptance procedures, Gloop and Corporation have accepted the engagement to review the cash flow forecast of $500,000 expansion funding. Okay, they won't receive 1.5 million. They will also only receive $500,000. So this issue was resolved. Okay, the next one is the financial controller has prepared a cash flow forecast for assumption for submission to the bank. The cash flow forecast covers the 3 years to June 2018. The financial controller is an inexperienced qualified accountant and his forecasting in prior years has been very accurate. Is an experienced qualified accountant. It has been accurate. All right, great. So I got no information from that point as well. So let's move towards the part B first of all. Bold it and write down the first heading relating to sales. The sales heading should also be bolded to make a good presentation within the exam. Now let's start the first paragraph relating to the first issue. The revenue is expected to grow within each of the years in the first year. The revenue will only be generated. The revenue will only be generated, not the revenue, sorry, the cash inflow. The cash inflow. Same is the case here. In the first year, cash inflow will only be generated from the existing 20 shops, whereas in the second year, in the forecast, cash inflow will also be generated from the new stores. It is not, now I'm going towards the issue that you are including the revenue from the shops even though they have just been constructed. So it is not possible to complete the construction of the shops within 6 months, yet the revenue from these 5 new shops has been included within the forecast. So this is a challenge that I'm relating to the management, that this is an issue with your forecast. This should not be the case. Hence, the revenue from the new shops would be delayed almost to the third year, or even after the forecast. The second issue within the same case is that the revenue from the existing smaller shops is equal to the revenue from the larger existing 20 shops. So I also need to write it down. Additionally, according to the forecast, the revenue from the new smaller shops has been equal to the larger shops, larger existing shops in other airports. This should not be possible. This should not be possible, as the new shops will be in smaller airports, and hence low passengers will be expected. Hence, the inflow of cash from these shops would be lower than the existing shops. I can also say that even if the shops are being constructed within the first 6 months, it is not possible to say that all the customers will come running towards your shops. No, that is not possible. It will take time to develop customer reputation, and then you will have a large number of sales. Additionally, even if the shops are constructed within 6 months, still it would take time to develop reputation and understand the customer's taste for new shops, and the inflow at first would be a lot lower than existing shops. Hence, giving the same amount of cash inflow, to the new shops is not a correct assumption, used by management, and hence the cash inflow is overstated. This is the first reason. The second reasons were the percentage increases. The management has used the inflation rate of 10% to increase the overall sales over 3 years, whereas the percentage increase of sales in the third year is 12.5%, which is not in line with the inflation rate. Additionally, the inflation rate itself is highly the inflation rate itself, no, you can't say this. Additionally, there is also the risk that the inflation rate used is not correct. Hence, because of more than inflation rate increase means that the forecast assumes that the number of customers might increase. The number of customers would increase. Obviously, if your revenues are increasing more than the inflation rate, what is meant by the inflation rate? Today you are selling something for $10 and in the future you will be selling it for $12. So there is an inflation rate of 10%. Now, if you will multiply 10 by 100 items sold, this will give you an answer of $1,000. Whereas in the second year, if you are just using the inflation rate to increase the revenue, this means that your price would increase because of inflation in the market and you will be selling your products for $12. Now, in the second year, you will generate a revenue of $1,200. So this inflation rate is determinable. Like, you can place a reliance upon this. But when you increase your revenue by 14 or 15% now, more than the inflation rate of 10%, this means that somewhere you are stating that the number of customers will also increase. The forecast assumes that the number of customers would increase in the last year, which might also not be correct, as currently, due to economic turndown, it is not possible to predict when would this return to normal. When would this return to normal? Hence, because of this, the revenue might, the inflow, sorry, not the revenue, that the inflow of cash might also be overstated. Great. We are done with sales. And now let's move forwards. If I move forwards towards the next point, obviously I've shown you how to write down within the exam and how to use each of the point for your supporting assumptions and to challenge the management assumptions. The payments to suppliers. Yet we see here that in the first period, the payments to supplier will be 750. Okay, now if I go towards the second number point, it says that inventory purchases have been calculated based on historical gross margin of 70%. 70%. This means 30% is the cost of sales. So if I calculate this 2500 or 750 divided by 2500 is equal to this multiplied by 100, this means that on an average, whatever revenue I make, 30% is what I purchase. So in the first year, there are 30% of the purchases. So yes, I see that the revenue, the cost of, I am assuming that whatever I purchase will be paid in that portion. The same is the case here. Whereas if I come here I see that the management is again saying that I will make 3 million of the sales, 3080 of the sales. So this means that if I take 750 divided by 3080 multiplied by 100, management is saying that I will only pay 30% are my sales, whereas I will only make a payment of 24%. The remaining 6% will be paid here. So this is a wrong assumption now. You are using the wrong assumption. In the first year, the assumption being used that whatever you purchase will be paid right away, because one of your major suppliers has said that they will not offer any credit to you or late payment options to you. Whatever you purchase, you will have to pay it right there and right then. But in the second year, you are assuming, oh, the supplier will again come running towards us and say, I have given you a credit limit and you can make late payments. Same is the case here, you are making late payments. Same is the case here, you are again making late payments. So this is not possible. This assumption again is not correct. So I can write about it as well. So I'll give a heading of payment to suppliers and bold it as well. Bold it as well. And if I come forwards to write the answer, the management has used the assumption of purchase cost of 30% of total revenue, and in the first year all of the purchases are paid for, whereas in the second year the purchases show the payments to supplier. In the second year the payments to supplier show that the management would be able to delay the payments to suppliers, as only 24% of the cost are being represented as purchases payments, whereas the rest of 6% will be paid in the next 6 months, which might not be possible as one of the major suppliers of the company has ended credit terms and only accepts cash purchases from Slander Corporation, and assuming the delayed payments means that the terms with supplier will be again that the terms that credit terms with the supplier would again be opened, which is a highly optimistic assumption and not possible, as it may take more time to resolve the issues with suppliers and avail credit opportunity. Hence, the payments to supplier are also possibly understated. That's it. That's all I need to write about the payments to suppliers. Now, if I come forwards, let's talk about the lease payments. Obviously, we have studied within the scenario above that all of the shops have been taken upon a lease. Where was this written? The company operates from leased premises. Now, obviously, if I talk about the standard IFRS 16 is applied to leases. Now, for lease, you have to make payments. If you remember correctly, the amortized cost model that we used for lease, it was the opening balance multiplied by the interest that would be added within the opening balance, and then you had to make the payments. We are basically showing those specific payments that we are talking about, and it is being shown that in the first period, when we only have the existing shops, will be making a lease payment in total of 1.25 million, 1.025 million. In the second year, the lease payments, because we will have 2 new shops in this period, if I compare it, so we will be making a payment of 1075 only for new 2 shops. Let's calculate what is the lease payment per coffee shop that we have in the first year. If we divide this by 20, because both of the amounts are same and in both of the years we have the same number of coffee shops, this means that 1025 divided by 20, this gives us a total payment of $51,025 to $50 in the first period. In the second period, 1025 out of 1075. This relates with the old ones, then this relates with the existing stores. What is the lease payment for the new stores? 1075 minus 1025, only 50,000. For 2 new stores, this gives us a lease payment of only 25,000 per store in this year. Whereas the next payments are consistent and the number of stores are also consistent. So if we take at the total amount, additional amount that we are paying and divided by the total remaining number of stores, we get an amount of there are two ways to calculate it basically. I can subtract this and just find the lease payment per 3 new coffee shops that I'm getting. I can also do this, or I can compare it as a whole by all the 5 shops that I have. So I would go towards this 1185 minus 1075. I'm doing this 1185 minus 1075. So this will give me an answer for 3 new coffee shops that I will have in this period in the next 6 months. This gives me a total of 110. And what is 110 divided by 3? So here I'm saying that I will make a payment of $36,660, round about this payment. So for the 2 new coffee shops that I open here, the per store payment is 25,000. Whereas if I open 3 more shops, per payment store is 36,660. Why this is not consistent? There is some kind of an error here, or you might have understated the cost. But we can state that these lease payments when compared with the old existing stores is very low. Why? Because the existing stores were at big airports, so the lease payments might be a lot. But when compared to the existing ones, these are at the smaller airports. Sorry, the new stores, these are at the smaller airports, so the lease payments will be low. But compared with each other, even these are not consistent. The 25,000 in the 2 new stores that we open and the 36,000 per store in the new 3 stores that we open in the second 6 months. So I can write, oh, I need to read the note as well. The note number 3. What does it say? The company leases 20 coffee shops as at 1st of July 2015. This means simple. There is nothing to write down in this note. So lease payments the existing lease payments for the 20 coffee shops amounts to a total of 1025 000. Whereas this means that the per coffee shop lease amounts to, how much was the amount for per coffee shop? 51,250. 51,250. Whereas in the first 6 months of the second year, the lease payment for new coffee shop, 2 new coffee shops is only 25,000. And in the next 6 months, the payment for 3 new coffee shops is 36,000. Now, first, I need to present my answer to the examiner that I have the commercial acumen. What? Because I will get professional marks for it. I need to present it to the examiner that I have commercial acumen. What was my commercial acumen? That I know because the new shops are at a smaller airport, I need to have an understanding of business. What is the understanding of business here? That the new shops are at a smaller airport. So I do understand that the payments will be very much lower than the previous larger airport shops. But they both are not consistent with each other. That is the major issue. So I'll state that it is understandable that the new coffee shop payments are lower than existing coffee shop payments because the new coffee shops will be at a smaller airport, but the 5 new coffee shops being opened have a higher difference with each other, such as the 2 coffee shops being opened in first 6 months. 6 months will have a payment of only 25,000, whereas the new coffee shops, the 3 new coffee shops, the 3 new shops, I can also write that only the 3 new shops, the 3 new shops will have a higher payment of 36,000. Let's write down a round of figure, 36,000. Both of these have a high difference. Hence, this may mean that either one is not appropriate, leading to misstatement within the lease payments. And may include misstatement within the lease payments. So I have identified the problem or issue here as well. Let's identify the next point now. If I come towards the next point is regarding the other cost, including staff, basically the salary of the staff and all the other cost as well. So basically, the first of all, you were saying that there will be a 10% inflation rate. So if I compare it, obviously the prices are increasing, so your cost would also be expected to increase by 10% because there is a 10% inflation rate. Everything increases by 10%. If you are living in a country, whatever country that is, if you are living in Africa or you are living in, let's say, Middle East or UK or Canada, whatever the thing is, if you are selling something, then inflation is going to increase your revenues. Whereas if you are buying something, that will also be expensive now. Inflation increases the prices of each and everything, round about by 10%. So if the company is assuming that the revenue will increase because of 10% inflation rate, so this means that your prices should also increase by, your cost should also increase by 10%, right? So compared to this, if I find the first increase in the first year, 550 minus 500 is equal to 50 divided by 550 multiplied by 100. No, I'm doing something wrong. 550 minus 500 divided by 500 multiplied by 100. So the first year inflation is 10%. Great. Between the 6 months, there is also then an increase. Why is there an increase within the second 6 months? Divided by 550 multiplied by 100, there is an increase of 13% here. If I move forwards, the cost is same then. All of the costs are increasing by this much same amount, but when compared to the third year, why are you not increasing the salaries of your cost, salaries of your staff, your employees? Obviously, in each of the years, we also need to increase the salaries of my staff. So there is a risk here that the staff salary should be increases, because if I look at this, in the third year, there is no increase at all. But the staff salaries have to be increased. Plus, when compared to the both of the years, here, both of the 6 months and the second year, the cost is increasing by 13%. Here, I think that the cost is increasing by too much. Whereas here, I think that the cost is not increasing at all. Whereas there should be an increase in the salary cost, at least by 10%, because the employee salaries are usually increased by the amount of inflation there is in a country. So there is a risk here as well. So staff salaries and other cost, I'll give a heading regarding this and bold all of this. And coming towards the point, I'll write down other costs and staff salaries according to forecast will increase by 10% in this first year. This is reasonable increase as prices increase by the inflation amount. Prices increase by inflation amount. The salary of employees and other cost should also increase by the same inflation rate. Should also increase by the same inflation rate. But in the third year, there is no such increase in either costs, meaning that the forecast assumes that no salaries would be increased, no salary would be increased of employees, which is highly impossible, and there would be no other cost increases. Hence, this cash outflow due to salaries and other cost within third year has a risk of understatement, whereas the same cost is increasing by 13% in the second 6 months of the second year. So the assumption of management to increase cost by more than inflation and cost being consistent in third year is not possible. Hence, the auditors should apply professional skepticism while reviewing these costs. That's it. That's all I need to write down regarding this. So if I look at the overall answers that I have written down first point for sales, second point for payment to suppliers, third point for lease payments, and fourth point for salaries and other costs. Within sales, I have written down, if you concluded, I have written down almost 4 points. So basically, I've completed my question here. If I consider the sales, I would be given 4 marks for this, 2 marks for this. That would give me 4 and 6 marks. Then 8 marks for this. Let's assume that salaries would give me 2 marks, or let's say 3 marks. The sales would give me 3 marks. 2 marks for this. This would be 5 marks. 2 marks for this. This would be 7 marks. And the remaining I have gotten 1 more marks, additional marks within the exam. So this is where I stop within the exam. I do not go even further, one more step further. I will go towards the next question, complete the next question. If I have any time remaining, then I would come back towards if I have any point writing it. For example, I would only identify it here. The capital expenditure in the second year would be $200,000. In the third year, it would be $300,000. If I look at it, because this is where we are opening the 2 new shops here and the 3 new shops here. So per shop, there would be an increase of $100,000. This is the same thing mentioned here. Capital expenditure have been forecast on the basis of $100,000 setup cost for each new location. 2 new coffee shops will be opened in the 6 months to 31st December 2016, and the 3 new shops will be opened in the 6 months to 30th September 2017. All right, this is great. If I come towards I have 1 point here. I'll come towards it at the end of this lecture. But if I come towards the next point, the marketing cost, there would be only 1 marketing cost. Now, I can raise a point for this as well, that obviously marketing would not be required at an airport because the customers do not have enough choice. There is not a lot of competition. But still, you need to make marketing consistently. So why is there no marketing cost in these years? And you are saying that you will do marketing. All right, you can say that the marketing will be done at the new locations because the marketing is being done when the new shops are being opened. But still, why is the marketing not being done here, not being performed here? Here it should also be a marketing cost, and it should be more than the 20, because when you are opening 2 more shops, you are doing a marketing cost of 20,000. So it can't be consistent in the second 6 months as well. It should be like 30 or something. So why is there no marketing cost here? But overall, there should be a marketing cost that should be consistent in the years, or should be increasing by the percentage of inflation. The reason, because there is no competition, I will mention this within the answer, that because there is no competition, the customers have a limited choice, there might be no marketing required. But still, you need to have banners. If you go to the airport, each shop has a banner, each shop has like a setup area, they need to pay for that. Each shop has a marketing that is out in the alleyway. Why? Because in the corridor. Why? Because they are trying to display that we have these items. So the customers are attracted. Nowadays, there is even a competition within the airport as well, in the shops. So coming towards this specific point, I would state that the marketing cost should be consistent over the years, not only when the new stores are being opened. And even if we consider the management's response that the marketing will only be considered done when the new shops are being opened, why there is no marketing being done in the second year? This might be a reason. And the marketing cost outflow of cash might also be overstated because of this. I can mention this as well. If I talk about the loan receipt, this states that I will receive a loan in the second, because I have confirmed this with the bank that I will not receive $1.5 million loan. If I come towards the question, it clearly states that I will receive only a loan of $500,000 right here. Right here. So if you are saying that you will receive a loan of $500,000, where are the interest payments, the repayment of the loan? Obviously, in the next years, you will have to pay the loan back. So there must be like $100,000 repayment here, $100,000 repayment here, $100,000 repayment here, $100,000 repayment here, the interest and the repayment that you will have to make. Where is this? This is a point that I can also raise here. So this is also a point. The loan repayment has been included 100, 100, 100, 100, 100. Where is the interest? You are showing no interest. Okay, the loan repayment has been included. I was wrong in identifying that. But where is the interest cost? Okay, it has also been included. So no point for this as well. The interest has also been included. Great. But wait a second. You will receive the loan in the second year. And you are saying that you will start repaying the loan in the first year. You will receive the loan in the second 6 months and you will start repaying the loan in the first 6 months. That is also not possible here. This is why this assumption is wrong. I will simply write down within my answer that the management is assuming that the loan will be received within the second month of the second 6 month period of the first year, whereas the repayments will start from the first 6 months of the first year, which is not possible. Hence, the repayment schedule being displayed might not be appropriate and is not correctly incorporated, because after the loan has been received, the repayments would start, not before the loan has been received. So this is also an issue within the forecast. Now the opening cash has been included here, the net cash flows have been included, and the rest of there is no issue in the rest of them. So where in the forecast, is there something missing? Yes, there is one thing missing. Where is the tax? Where is the tax? I don't see any kind of tax repayments here. You obviously, when you make profits, you also have to pay tax. Where is the tax? So I can easily write down another point here. So basically, I can write down another point here, that the management's forecast does not include any type of tax payments within the cash flow forecast. Obviously, when the profits are being made, the management will have to make tax payments upon the profits, and those tax payments need to be shown in the forecast, as they are a part of cash outflow, which the management has not shown. Hence, the tax payments have been understated or not shown at all. So in addition to the 4 points that we have written, there is a loan issue as well, whereas the repayments are starting before the loan is being actually received, and there are no tax payments. These are the 2 new issues that we identified. Furthermore, there is a third issue we identified, that capital expenditure is being shown, whereas there is no capital additional expenditure being done. Marketing cost, if we look at the marketing cost, there are only marketing costs within the first year of the new stores being opened, whereas the marketing cost, I will state that the marketing cost should be consistent over the period. Still, some marketing is required, even though in airports, customers do not have enough customers do not have enough choices. There is a limited choice and there is less competition, so marketing might not be required. But even though if marketing is not required for the 3 new stores being opened, some marketing will be done, and for that marketing there will be a cost, and a cash outflow should be shown for that marketing as well, whereas it is not being shown. These are 2 points that I am raising. So if I come to the capital expenditure which I was talking about, when you do a capital expenditure, let's suppose I'm building a home. All right, now remember this. Let's say I get a lot of money influx and I start building my own home and I want to shift in that home. The home will be complete. That is the capital expenditure which I have already done. That home is complete now. When I shift to that home, that new house that I bought or that new house that I built, obviously after shifting, I will find some types of errors within that home, some types of miscalculations. So a new door is required here, a new laundry room is required here. So for that, there will be adjustments, there will be new capital expenditure to even further renovate that home. Why are you not adding it here? You are saying that a new coffee shop will be built, that's it, no more capital expenditure will be required. There might be more capital expenditure required. In addition to when you have actually opened the shop, you might find some kind of issues within the shop. The counter is not perfect, the machine is not working, this is the issue, this is the issue. For those types of issues, new capital expenditure might also be required. So basically, if we count the new issues that we have identified, the first issue is with the capital expenditure, the second issue is with the marketing cost, two issues with the marketing cost, with the loan itself there is one issue, and with the tax not being there, the tax payments not being there, this is the fourth issue. So in total, we have identified 4 new issues even after completing the question itself for the required number of marks. But remember, within the exam, when you have completed the required numbers, move on, do not stay within the question. Move on towards the next question, complete the next question. When you are done with the exam, if you have any time remaining, come back towards the question and then attempt the question. So this is the second question done for the March and June 2023 exam.